Welcome to the Weekly Juice Podcast, where we discuss all things real estate, personal finance, investing, entrepreneurship, and the many ways to achieve financial independence. We interview accomplished investors and entrepreneurs with the goal that their stories inspire you to take control of your financial future. Here to get your creative juices flowing, while also documenting their own personal investing journeys, are your hosts, Corey Jacobson and Ryan Bevilacqua.
Welcome back to the Weekly Juice. As always, it's your boys Ryan and Corey here with another episode for you. Today we had on a very insightful and educational episode. We interviewed Thomas Castelli. He's a CPA and real estate investor based out of New York, but his company is national, so he can help out real estate investors all over the states. He also runs the Tax Smart Real Estate Investor podcast. So he basically does what we do, but talks specifically in the niche in the lane of how you can reduce your taxes if you're a real estate investor, and work specifically with our niche. And honestly, we've had a few other real estate focused CPAs on the show, and they've been great. I will say Thomas helped us go even a layer deeper and up to the 2024 code and really talking through a lot of things that we had questions for in our business, but then also for the basic W-2 earner and maybe someone that has a W-2 and is investing in real estate on the side. This episode really helps break down how you can save money by tax preparation and tax planning, strategic tax planning ahead by starting in the beginning of the year, planning for the future months and quarters that are coming up, and really helpful stuff that we're going to weave into our business.
Yeah, you didn't leave really much else for me to say. I was going to mention how this is a pen and paper type, like listen to everything all the way through, because I learned something new. You know, I've joked on the podcast, I learn something new every year in taxes, because I do. There's all these different types of strategies that unless you have a fire CPA, like you're not going to know. And Thomas went deep with us. You know, he talked about, and you'll listen to it in the show, about seven strategies to destroy capital gains. So there's a bunch of different strategies. Some I've heard of, some I haven't heard of, but anyone who is a real estate investor or who's in business is looking to pay less in taxes. This episode has a lot of strategies that explain exactly how to do that. And that's what I think people want from a podcast. I mean, so a little bit shorter of an episode, we get right to it. Not a lot of fluff, not a lot of storytelling. We do get some philosophical stuff at the end about his why, but it's really like dive right in. Tell me how you can help me. And Tom did just that.
He really did. And one thing I want to point out towards the end of the episode, we talk about how to write off the G-Wagon, right? We've seen, and it's not specifically a G-Wagon, but it's a vehicle that weighs 6,000 pounds. And we've seen this clickbait all over Instagram, all over the reels. And he really breaks it down to let you know the exact dollar amount you could save by buying a vehicle like this. And it's actually not as much as you think.
Well, it's good though. But it reminds me of that. What was the show that was like, it's a write-off? Like I was at The Office or something where they're talking about like, oh, it's a write-off. Like,
Schitt's Creek.
Yeah, Schitt's Creek. He's like, oh, it's a write-off. Like, what the fuck is a write-off? Like, we explain what a write-off is, and just what you just said, like, oh, how much it'll actually save you dollars in your pocket, not like you buy $100,000 car and you end up spending $20,000 on it. It's like, how much can you really save?
And who it's the right fit for and when to buy.
Exactly.
So, we actually demystify the actual reel and the whole G-Wagon scenario. But Thomas is the man. And if you are looking for a CPA, he's very, very knowledgeable. Listen to this whole episode. I think top to bottom, it's insightful. And you, as Corey mentioned, bring your pen and paper.
Yep. Let's bring Tom in.
Tom, officially welcome to the Weekly Juice Podcast. Corey and we're so excited to have you on the show, man. As I mentioned pre-recording, we have a lot of real estate investors or aspiring real estate investors that listen to the show. And one of the major pieces or key members to the real estate investing team that we all have to go through and build is a CPA. So we are so jacked up to have you on the show, man, to drop some knowledge on us. So thanks for joining us.
No, thank you guys for having me today. It's an honor to be here, and I'm looking forward to breaking down some tax knowledge for everyone.
Yeah, let's do it. I think before we get into kind of the nuances within and tips and tricks, just take us back. Like, how did you decide that you wanted to be a CPA? Kind of what was your vision with everything? And then take us to how you became an investor and where you are today.
Yeah, absolutely. So I'll try to keep this as a story as short as possible. So long story short, I was always saying since I was a kid that I'd be in business. My parents were always saying go to school for accounting because my mom worked for an accountant. My aunt was an accountant. She did well. So they're always kind of pushing me in that direction. So I went to school for business management and accounting, and probably around my sophomore year, I started picking up books. One of the first books I picked up was Rich Dad Poor Dad. I'm sure many of us have read that book, and really there was a theme in that book that real estate is the way to build wealth, and it was just a common theme. So I started learning everything I could about real estate, podcasts, books, you name it. Then around my senior year, right when I was about to graduate, my great uncle had passed away, and he had a relatively small house on a relatively large property that was right down the block from the Long Island Railroad that went directly into Penn Station. So I knew that for city commuter, that was a 5-minute walk. That's like a gold. So I went ahead and I went to a local RIA trying to get someone to help me wholesale or flip or develop the property. I was in my early 20s, just fresh out of college. I had no idea what I was doing, right? Long story short, we never flipped or did anything with that deal. The executor of the estate ultimately took care of it and sold it. And someone did put up 3 houses, which was just painful to watch. But basically, though, I learned about real estate syndication at this event, and there was a group doing a 3-day weekend on real estate syndication. So I said, let me go to this 3-day weekend before I start my full-time job in September. So I went to that summer 3-day weekend, fell in love with the real estate syndication model, started going to their monthly meetups, and ultimately invested with a few of the partners there as a limited partner. And they said, hey, Tom, look, if you ever find a deal that pencils out, we'll syndicate it with you. And I was like, all right, cool. So this is all now as I started my full-time job as an accountant, started becoming a CPA. I was in the middle of looking for deals, and we ultimately syndicated an 82-unit apartment complex, which was really exciting. But then after doing that, I said, how can I marry my tax background or my accounting background with real estate? And that's how I became a tax strategist here at Hall CPA, where I help real estate investors reduce taxes. So it's like a nice marriage of the two backgrounds.
Yeah, absolutely. I mean, every single person that isn't a real estate investor is looking for a go-to CPA, and they're kind of hard to come by. And candidly, Ryan and I can talk about this. We are on our 3rd CPA in 3 years, right? And we're not going to say any names or anything, but we found somebody who we got connected to recently through a community, and we feel like they're a really good fit. So it's going well so far, but to transfer all that information over and to get everyone else up to speed on all the things that happened the year before, it's like, it's a pain in the ass. So like the marrying between the real estate and the CPA, it's a really, really important one. I'm curious, maybe some high level strategies that you're seeing that are working in 2024, or just some, even if you want to go basic, I'm just curious about maybe what you're seeing in the market, or some tactics that you felt you can provide value to your clients with that maybe we haven't heard of, or just, if you want to spitball a couple things.
Yeah, absolutely. I would say the biggest thing is that a lot of times people get caught up, and we could talk about this, of course, about the ability to use non-cash losses from rental real estate to offset, say, W-2 or active business income to significantly reduce taxes. And that's certainly powerful. And if you could take advantage of those strategies like the real estate professional status or the short-term rental loophole, by all means, you should absolutely take advantage of those strategies. But what I want to walk people back into is just by investing in rental real estate to begin with, you are putting yourself in a very tax advantageous position. And I'll explain why briefly. So if you have a job or you have a business, you can be taxed up to 37% at the federal tax bracket. Okay. And that's just federal. Then you have to add on state tax. If you live in a state like New York or California, you'll be paying up to 13.3% in addition to that in state taxes. Then you have FICA, which is 7.65% of your salary up to a certain amount, and it drops off. And if you're self-employed, you get to pay double that. So 15.3%. So when you add all of this stuff up, you can easily be paying, if you're a high income earner, 40 to 50% of your income in taxes. And we see it happen all the time. It's painful to watch. However, with rental real estate, there's a non-cash expense called depreciation that shelters your income from tax, despite the fact that you might actually be generating positive cash flow. So let me give you a quick example. Let's say that you had $100,000 in rental income, and you had $45,000 in operating expenses. I'm talking about property taxes, repairs, maintenance, all that good stuff, right? You'd be left with $55,000 of cash flow. Now, in most businesses, you'd pay taxes on that $55,000. So, if you had a tax rate of, let's just call it 40%, you're paying roughly $22,000 in taxes. But now let's just say that $100,000 is rental income, right? or did I start with that? Okay, yeah, it is rental income. But let's just say that you have a non-cash depreciation expense of $60,000, right? So in this case, now you would have $55,000 of cash flow that's going to your pocket, but you're telling the IRS that you lost $5,000. So you're saying, hey, IRS, I lost $5,000, which means you did not pay any tax on that $55,000 of rental income. Whereas conversely, had you earned it through a business, you're now paying $22,000 in taxes on it. So just shifting your income sources from earned income sources, I mean by shifting, by kind of pouring your earned income sources into rental real estate, you're already putting yourself way ahead of the curve. And I know there's a lot of tactics and stuff we'll dive into, but just understanding and realizing that fundamental shift in and of itself is a huge move towards a more efficient tax situation overall.
Yeah, no, that's a great breakdown, and the way they explain that depreciation, I think it gets thrown around a lot. So to hear it explained that way is awesome. You mentioned something about the short-term rental tax loophole. I'd love to talk about that, and the reason why I want to ask is because we have short-term rentals, but they're managed by a property management company, and I know now that you can't use the loophole if you are not the active manager of your property. Is that correct? Correct me if I'm wrong, but that's what I've heard. And I feel like I've lost out on a bunch of tax savings because I have a property manager, which makes my income from my short-term rentals and our income passive instead of active income. Is that the loophole there?
Yeah, right. Exactly. So the way this works is kind of just taking back to the example I gave before, you have this $5,000 loss you're telling the IRS that you have. Now, rental activities are quote unquote passive underneath the tax code. And that means that $5,000 can only offset, that $5,000 loss in this example can only offset other passive income, such as rental income or other passive income you might be generating. Now, there's a way around that called the real estate professional status. And I'll tie this into the short-term rental loophole. Now, the real estate professional status, if you're working more than 750 hours and more than half your total working time, so more than 50% of your total working time, you can use your rental losses to offset your W-2 or your business income or perhaps your spouse's income. Now, the problem with the real estate professional status is you need to spend more than 50% of your total working time. So if you have a full-time job or if you have a full-time business that you're running, it's virtually impossible, as proven by tax court cases, to do this. So that's kind of where the short-term rental loophole comes in and makes things interesting. So the short-term rental loophole is actually not really a loophole at all per se. It's actually designed for hotels. So if you have an average period of customer use of 7 days or less, or 30 days or less, and you provide quote unquote substantial services, which are like daily cleaning, meals, things you'll find at a hotel, then your rental property is not a rental activity for the purposes of the passive activity rules. Instead, it's treated like a business. And when these rules were put back into place in the 80s, presumably you weren't able to go put a single family house, in the suburbs on Airbnb and rent it out. So which is why people call it a loophole. But you have that average stay of 7 days or less, which is the common one. Now all you have to do is you have to materially participate in the activity for the losses to be non-passive or to be able to offset your W-2 and active business income. To do that, there's one of three tests you have to pass. Either you spend more than 500 hours on that property, or you do substantially everything yourself, or you spend more than 100 hours and no one else spends more time than you. So if you meet one of those three tests, the losses from your short-term rentals will be non-passive, even if you're not doing it full time. Now, the issue with property management, to circle back on that, is that if you have a property manager, the IRS is assuming by default that you are delegating the day-to-day management of the property and that you are not materially participating because the property manager is doing all that. So oftentimes, or more often than not, in most cases, if you have a property manager, you're not going to be able to meet one of those three tests. And even if you are, you have to be able to prove it to the IRS. So it's challenging to do that. But that's the short-term rental loophole in a nutshell.
Got it. Cool. A lot of real estate investors are looking to defer capital gains. And that's like one of the big things, either defer capital gains or just avoid them altogether, right? I was listening to a podcast that you did the other day, and you mentioned that there are, I don't know if it was you or the guest, and we don't have to go through all these strategies, but there are 7 strategies to destroy quote unquote capital gains. That is exciting for people that are listening. Like, okay, how do I not pay this? Because as an example, Ryan and I, actually this property I owned by myself, I have to pay it in this year's taxes. I sold I bought a property in 2020 for $120,000. This 2023, I sold it for $210. What did I say, 120?
Mm-hmm.
So yeah, that's $90,000 of, that will be taxed capital gains. I couldn't really figure out a way to get around it this year, but you have ways and good CPAs do using specific strategies. I'm gonna list these out just so people can hear them. Maybe they can look them up on their own. And then if you want to dive into some specific ones, that'd be really helpful. But the 1031 exchange, which a lot of people have heard about, 1031 into Delaware statutory trust. No idea what that means. 1031 into mineral rights. Also no clue. Qualified opportunity funds, seller financing. We know what seller financing is. And then a 721 exchange. I wrote down here in parentheses, what is this? Because I also don't know what that is. Maybe besides the 1031, because I think a lot of people do know where you have a 45-day period to basically trade up your property. And then that defers the capital gains that you would pay if you sold it to the sale of the next property. And you can kind of forever do that, kick the can down the road, which is awesome.
Right.
Maybe if you want to give us some ideas of some other ways to defer capital gains, I think it would be beneficial, especially right around tax time.
Yeah, absolutely. So I'll start with the first one, the lazy 1031 exchange, which actually has nothing to do with a 1031 exchange at all. But it gives you comparable benefits. So I think this is a really important one that a lot of investors often overlook. So the way that the lazy 1031 exchange works is, remember kind of what I was talking about before, the losses from your rental activities are passive, and they can only offset passive income or gains from the sale of other passive activities unless you qualify for reps or short-term rental loophole. So what the lazy 1031 exchange does is it says that when you sell a passive activity, so when you sell a rental activity, you have a gain, you can use passive losses from either that property or other properties to offset that gain. So what happens is in the year that you sell your property, say you have a $90,000 gain, you might say, hey, look, where can I find passive losses to help offset this $90,000 gain? So it's possible to buy another property, perhaps, and run a cost segregation study on it, use bonus depreciation, increase the non-cash losses from it, and use it to offset that gain on sale. So that's kind of the lazy 1031 exchange. What you're doing is you have a gain on sale, you're finding passive losses to offset that gain, and that does not require you to use a 1031 exchange, but gives you similar benefits. That's kind of the first one.
Okay, cool.
I could dive in from there. So the other ones that you mentioned, the 1031 exchange into Delaware statutory trust and mineral rights, that's just using a 1031 exchange instead of 1031 exchanging into a property that now you have to be responsible for. The Delaware statutory trust is kind of like a real estate syndication where somebody else is running the show and you take the passive back seat. With the mineral rights, you're actually buying pretty much an oil and gas investment, long story short, and you're collecting mineral royalties as a result, and that's passive for you because the oil company is going to drill it and give you the royalties from the minerals or the minerals or the oil that they're drilling. Now, the other one, the 721 exchange, that one's pretty interesting. So that is this is almost basic partnership tax law, but it is a little bit complex. So the 721 exchange, basically what happens is if you contribute your property to a partnership, the partnership's gonna accept your property into the fund and give you an interest in that partnership, and you're not gonna pay taxes on that property until you sell your interest in the partnership, or until eventually the partnership sells the property. So that's a 721 exchange. It's a great way to diversify your portfolio and get out of active management. So you might contribute your property to a real estate fund, for example, where they have a diversified pool of assets, and now you're just collecting checks and you're not having to deal with the day-to-day property management of it all.
Cool. So that makes perfect sense. I mean, I didn't know anything about these mineral rights, and it seems complicated, but having a good CPA on your side is, it's the only way that anybody would know this. There's no other way to track it down yourself. I mean, you could, but it seems like you'd be wearing too many hats. I know it's like that for us. We actually just went through a situation where in 2023, in February, we had a fire in our property. We've talked about it on the show, and we received an insurance payout. We ended up paying off the property and selling it. So we're going to have to pay capital gains on it. But there's a rule called the like kind exchange, 1033. Just learned this, where we have to buy a property that is, it's like basically like a casualty kind of exchange, where if we buy a property in the next 2 years that has of the same or more value, we can exchange that, similar to a 1031, where we will defer the capital gains into that next property, where we just have to buy the property in the same business, and we have 2 years to do so. So that was a good problem to have, because our insurance payout was more than our property was worth. So that's good. But, we would have a hefty tax bill if we didn't have that like kind exchange. So things, I was mentioning this to Rye and you pre-show, I learn a new thing about taxes every single year. It's like, having a good CPA, I just keep reiterating it. It's just such an advantage.
Yeah, I want to talk about this. And Tom, hopefully you can go into this for people. I know it's so basic. I'm bringing it back, dialing it back just a little bit for everybody. But can you talk about the difference between like filing your taxes and then tax planning? Because I really want to dive into how important tax planning is for people that don't know about it. And the reason I bring this up, and just a quick like side note on this, is having a W-2 for 10 plus years, right? Like I've always just been used to, I file my taxes when tax season comes around. And then you get the way I like hold back certain taxes or pay additional, I would always come back with like, I was getting paid, right? And it was nice. And we look forward to the tax return.
Been a while since that happened.
It's been a while.
Yeah.
So conversely, now when you become a business owner, we always feel like we're paying taxes. We're just trying to find ways to save. And that's why we hired a CPA, right? So, some people file their own taxes. If you just have a W-2 job, you might not need a CPA. But anytime you start a business, I recommend hiring one. And the reason being, tax planning comes into play. So talk about the difference between filing and planning, and then the beneficial aspects of planning.
Right, absolutely. So when you have a tax return, your tax return is basically like a report card of the income, losses, deductions, et cetera, that you did from the year before. So once the year kind of ends, there's usually very little things you could do to actually change and influence that tax return. The results are what they are. So what tax strategy and planning is looking at your situation currently, saying, okay, what are your current income streams? What are your current investments? What are your goals over the next 1, 2, 3, 4, 5 years, however long you want to look out? And saying, okay, well, based on where you are today, based on what you're looking to do, here's the moves you can make. Here's the strategies, deductions, things that you can implement into your tax situation to reduce your taxes, so that when it does come time to file that tax return, whether it's the next year or sometimes even years down the line, you're able to reduce that, and you're able to put yourself in a more favorable tax position than you were before. And oftentimes what happens with most CPAs is that they just file your tax return and they say, see you next year. And that's it. They don't tell you what you can do to actually say, okay, well, if you just made this move or you made that move, you could reduce your taxes by 10, 20,000, however much money. And people don't, and that's the difference. The tax preparation is simply a compliance item. We're putting numbers onto a form and submitting it to the IRS on your behalf, which is complex and it's complex in and of itself. Don't get me wrong. But the actual tax strategy and planning aspect of it is actually saying, what can you do to influence the results of that tax return? And that's what it is. That's the difference in a nutshell. One of them is strategic planning and taking action so that you can come up with better results when it comes time to put those numbers on the paper.
Yeah, this might be a question for a lawyer. I'm not sure if it's a lawyer or CPA question, so you can give us the whatever answer you'd feel comfortable giving. But I'm curious about how you structure. Do you have maybe your own rental properties, or do you advise your clients to put 2 to 3 rental properties in an LLC for tax purposes, 1 in an LLC for tax purposes, 10 in an LLC? And the reason why I asked this is because Ryan and I just kind of reshifted the format of our business structure, where we opened up a holding company, right? So our holding company owns a new business that we just started, where we're doing a lot of creative financing, I believe, right? Mm-hmm. Yeah. And then it also owns 50% of that, but we're going to put properties within the LLC of our, Adelphia Property Solutions is the name of it. We're going to put properties in there, but I'm wondering, is there a point where you feel like, don't put too many properties in there? I'm kind of rambling a little bit. I'm curious if you have maybe some basics or some, what would be the word, like, normal practices that you use that makes the most sense.
Like a business structure hierarchy, I think is what he's looking for, is like and not to cut into here too far, but like a holding company at the top, and then it owns specific LLCs underneath. And then within those LLCs, are you saying, hey, if I buy a property in New Jersey, should I just have that New Jersey LLC hold one property? And then if I buy another property in Jersey, do I open another LLC? And then, if it's in Pennsylvania,
you're filing 25 with your
exactly.
Your
is there a way to consolidate? Like, how do you guys run it or advise your clients on the back end?
Yeah. So the first thing I'll say is that LLCs are primarily for asset protection purposes and for legal protection. So that's the primary benefit of them. They're typically not for tax reasons. However, they do come up, and there's some things you want to avoid. So first thing I'd say is don't put a rental property in an S corporation. Don't panic if you already have one in there, but just you don't want to do, because you have to remove it. It can be treated like a sale. But in terms of what we recommend for clients, so we work with a lot of attorneys through our clients because we're collaborating on entity structuring. We believe in general that simplicity is the better way to do it. So because you kind of, what ends up happening is you have these big entity structures, and if you're not maintaining them properly, you lose the asset protection, according to the attorneys. I can't give legal advice, but if you're not maintaining them properly, you might as well not have them at all. So what we typically recommend is you'll have a holding company, like kind of like what you mentioned, either in like Wyoming or Nevada. And then that holding company will either be a single member LLC if you're the only owner, or it will be a partnership. And I'll get into more of that in a second. And then underneath that, you'll have single member LLCs that are owned by the holding company, and those will own each individual property. That's typically what we'll see. As for putting multiple properties in the same LLC, that you usually would do that by state. So maybe if you have, say, an LLC in Florida, for example, you might put 2 or 3 properties in there. It comes down to your risk tolerance and how much equity you want to expose yourself to, right? Because again, while I'm not an attorney, if you have 3 properties in an LLC, my understanding is that, say, property A gets damaged and someone sues you on property A, then they can attack all of the other 2 properties within that LLC. Whereas if you have them all separated into different LLCs for each property, it's kind of like the Titanic. When the Titanic was sinking and they're closing the gates or whatever on the bottom of the ship to make sure the water doesn't leak into the other sides. It's kind of like that. And it just comes down to your risk tolerance. There's different philosophies. There's no one size fits all. You could put multiple properties in one if you're comfortable with that. But that really depends. But from a tax perspective, that's a sound structure. Now, if you have the single member LLC at the top, that will just roll up into your 1040. If you have a partnership at the top, that will be a separate tax return where you'll get a K1 that will go in your 1040.
Got it. Yeah, thanks for that. And it's funny, we're throwing around all these lingos like K1, 1040, all this. Like that. This is why it's important to have a strong CPA on your team. And specifically, Corey and I will not hire a CPA unless they are either a real estate investor themselves on the side, or they have experience in investing in real estate. Maybe they don't have the properties now, but they did at one point, because they understand the numbers, they understand the strategy behind it. It's like real life Monopoly, but you actually have like a puppeteer helping you navigate. I want to talk about the corporate structure. So thank you for that. There's a bunch of different companies out there. Some people will ask their CPA, who gets referred to an attorney, right? There's also companies that do this. One company we came across recently that's been great is Prime Corporate Services. They're based out of Utah. Give them a shout or a look online. They were referred to us by the community that we're in and one of the newer masterminds. And they were cool. They were great. And they had a structure built down. It was very similar to what you mentioned, and educated us on the back end of things. So I think for people looking, we were searching for a while, and some attorneys have different ways to do it, right? And it changes state by state, and we're just finding a lot of different nuances and preferences based on legal protection. So, and especially if you have a customized, everyone has a very different scenario. Like maybe you still have a W-2 job and you have a couple businesses on the side. Maybe you're a full-time real estate professional. There's not one size fits all. So make sure to do your research, but that's one company that I found was pretty good.
And one thing I want to jump into, Tom, real estate professional. You mentioned this before. You cannot be a real estate professional with a W-2 job. I don't know if you talked about this specifically. Is that correct? Can you? Is there a way to do that, or is just no?
So theoretically, you could. Theoretically, however, tax court, the IRS will assume automatically that you're not able to reach it. And then if you do make it to tax court, there's been like literally hundreds of tax court cases on this at this point, and like nobody makes it through. Like it's been one person who was able to prove that they worked a very small amount of hours at their W-2 job. but most people will lose that tax court case. So while it's theoretically possible, in actuality or in reality, it's often it's practically impossible. So if you have a W-2 job, we often see what we see as a strategy as a way around that a little bit is to say you're married, right? And your spouse, either you or your spouse can be like one spouse has the high income job and then the other spouse would be the real estate professional. And because you're married, filing a joint return, you both benefit from the real estate professional status. So while it's theoretically, practically impossible to do by yourself, if you have a full-time job, that's one way around it.
That's cool. That's helpful. Can you explain what a real estate professional is, real estate professional status? I know you kind of already did that, but just give it to us in a nutshell again, and then talk about just the benefits of that, right? Like, I don't know if we specifically went into it, but like the differences of, why it may make sense for someone to leave their W-2 job if they're on the cusp, right? Do you get more benefits of going full-time? For like, prime example for Corey and I, like we're at the point where we have a lot of real estate on the side. We're building some businesses. We have great paying W-2 jobs. And at some point we're like, okay, we got to take the jump to go full-time, but we don't know the full benefits, right? They're like, we're teetering. We know like insurance is high. So like maybe we have great benefit packages with our W-2s. You keep using that and like strategically weaving things. And I think this is very relatable for people that are listening that are probably going through the same thing. So maybe why would someone want to potentially leave their W-2 job if this, is the real estate professional status worth it?
Yeah, that's a great question. So the real estate professional status, what it does for you is it allows you to turn the losses from your rental properties non-passive and be able to use those losses to effectively reduce the taxes on your W-2 or your spouse's W-2 or the active business income that you're generating, then your non-passive income. So that's the major benefit of it, and it can be quite powerful. And we can talk about an example, but that's what it does. Now, to qualify, you need to spend more than 750 hours and more than half your total working time in a real property trade or business. Now, real property trades or businesses, there's 11 of them. We're not going to go through each and every one of them, but basically it's like you're developing, you're in construction, you're flipping, you're in rental properties, you're a broker, you're an agent, something along those lines. Those are real property trades or businesses. Now, when does it make sense to actually leave your job for this? Well, it kind of depends. So the question that I'd have is if I was advising somebody and they were considering leaving their job, I'd say, hey, is between the tax benefit and the additional income you think you can make by not focusing on your job and going full time into business greater than the salary and the benefits, your total compensation that you're getting from your current job? If the answer to that question is yes, so basically what I'm saying is that the additional income and the tax benefits are in excess of your current salary, that's when it may make sense to leave.
Let me ask you this. I'll give you an example. I'm just going to kind of ballpark some numbers here. Let's say, for example, you make, I don't know, $120,000 per year and you're in a specific tax bracket, right? That's your W-2 income. And then you go full time with real estate investing. And let's just say you generate $200,000 a year or like 150. You're close to that W-2 number. Are you going to pay more in taxes in the W-2 job versus are you going to be able to hold more cash at the end of the year if you go full time and have with that? Maybe I'm off. Maybe I should say $150,000 W-2, $150,000 real estate professional status, and you leave the job. Will you pay more in taxes at the W-2 or more with the real estate professional status? Like how am I going to hold more in my pocket at the end of that year?
Yeah. So if you had 150K of income, like from real estate, right? Is that okay? Yeah. That's actually an interesting question. I would say it's hard to say because if you leave the W-2 job without doing like the calculations, if you leave the W-2 job, you're not going to have your net income from that after taxes, right? However, you may be able to shelter that $150,000 or a substantial amount of $150,000 from tax as a real estate professional. So it's...
Yeah, I can give you some more context and not to put you on the spot. I think it's more so like strategically, if you were in all these syndications, Tom, let's say you're making passive cash flow from syndications,
right?
But you also have your own active real estate business that you're doing on the side. When you go to do your taxes, let's say you are a real estate professional, what you're saying is the cash flow that you make from, let's say you're in 5 syndications, you can use that to write off that income against your active income for your flipping business or for your personal rentals that you own because of the real estate professional status. Sorry, I don't know if I explained that 100% well, but is that the status that you get basically? Whereas if you had a W-2 job and you had all this, you can't take the passive losses from the cash flow of the syndications against your active W-2 job.
Right. Exactly. So if you were, so if you did not have the real estate professional status, long story short, if you did not have the real estate professional status, you would not be able to use the losses from your syndicate and fund investments or your direct real estate investments that you maybe are managing yourself or whatever the case is, against your W-2 income. That's not possible because you wouldn't be a real estate professional. However, if you're a real estate professional, then that becomes possible. So what I would say is that if by doing that, if by leaving your W-2 job and leaving whatever that net income number is from your W-2 job you're getting after taxes, if leaving that would allow you to use the real estate professional status to offset your other income that you're generating in the real estate side. And if that delta, if the difference is if you're able to save more money by becoming a real estate professional and leaving your job than you're getting paid by your W-2 job, that's when it can make sense to make that jump. Another instance where, so I guess to summarize that real quick, what I'm trying to say is if by leaving your job, the tax savings from the real estate professional status are greater than the money you're making from your job at net of taxes, then that's when it makes sense. There's another situation that makes sense is that say we see this all the time. We might have a couple that's one spouse is earning a substantial amount of money. And then you have another spouse who has a full-time job, but they're not earning a substantial amount of money. Sometimes by that one spouse who's not earning a substantial amount of money, by them leaving their job and becoming a real estate professional, the tax savings that they would receive by becoming a real estate professional, offsetting the high income spouse's job, is greater than the salary they're getting paid. So there's some cases where that would make sense to leave a job.
So let me ask you this: in that exact example where one spouse makes more and then the other spouse, how do you weave in that spouse? Let's just say they're not within the real estate business yet. How would you weave them in to being full time? Like, do you make them a team? Like, is it bookkeeping? Yeah, exactly. Like, what role would you give them for it to put in those hours?
Yeah,
and how do you track that?
That's a great question. So they would run the show. That would be their role. Their role would be basically to take over the real estate operations for that family, right? So they would be the ones.
All right, sign your wife up.
I was thinking, I'm like, how do I get this to work?
Sign her up, dude. She's ready.
Yeah,
she's gonna take over. That's great.
All right, that's good. That's good. But
it's good.
There's probably other people out there that make sense, or like, that was a good example. So you got my wheels turning.
Yeah. So a couple more questions as we kind of wind down here. I'm curious about your specific goals, Tom. Like, what are you looking to do with either your real estate portfolio, your tax business? What's the, I'm not sure if you thought about it or not. What's the next 3 to 5 years look like for you, and where are you trying to get with it?
Yeah, that's a great question. So there's kind of two sides for me. There's the CPA side and the investing side. So I'll break down the investment side first, and then I'll do the CPA side. So I've been investing in syndicates and funds for years now. And one group I've done a number of projects with, I was in the original fund. So I just became a fund manager with Dual City Investments. It's a real estate investment firm where basically we acquire multifamily and commercial assets in a fund and help passive investors invest. And we actually do 721 exchanges into that fund. So that's an interesting tidbit there. So for the next 3 to 5 years, I really want to help them scale out their investor relations arm so that we can take down more deals because they're excellent operators. I'm coming in to help them with investor relations. So in the next 3 to 5 years, I see that arm of that business getting built out. As for the CPA firm itself, we're on the road. We want to hit $100 million in the next 10 years in business. So for me, I'm operating our Tax Smart Investors business unit. So the next 3 to 5 years for me, what that looks like really is systematizing that end of that business unit so that it's a well-oiled machine and I can step out of that and have somebody else manage it. I can go do the next thing within the firm, whatever that is. So that's kind of what the next 3 to 5 years looks like for me. But as a firm overall, as a CPA firm, we're very well structured at this point. and poised we are able to acquire talent and take on new CPAs, train them up, get them rocking and rolling. So that's exciting to see that grow over the next 3 to 5 years too. But that's kind of what I'm involved in.
Yeah, that's great, man. To give people some context on what they can also do within a W-2 job, you're working full time and investing in real estate, whether it's the LP or the GP. Can you paint the picture of what your portfolio looks like on the real estate side? Because it's impressive to hear all this. I'm curious where you actually stand and whether it's LP, GP, whatever you own on your own, if you do, because you're driving this CPA business full time, and it's possible to do both. We're doing both right now. And at a certain point, it does make sense, but you can kind of ride that dual income, if you will, as long as you can. So I'm curious, what does your portfolio look like?
Yeah, so today I'm mainly a passive investor. So I have a number of syndicate and fund interests. So I'm invested in an industrial fund. I'm invested in a multifamily fund. I'm invested in the fund with Dual City. I'm invested in an ATM machine fund that I'm using to finance a car, which is going to be pretty cool because my car's dead, pretty much. It's on its last leg. And then what else am I? And I'm in a car wash fund. So that's my portfolio. Within Dual City's portfolio, there's a hotel, there's a self-storage unit, there's an apartment complex, and then there's a few other assets that are in there. But that's kind of what my portfolio looks like. I'm mainly on the passive side. You know, what's interesting though, there's a book called Who Not How by Dan Sullivan and Dr. Ben Hardy. Phenomenal book. And it says like you want to be focusing on your unique ability, your whatever skill set you have that you can be world class at. You want to lean into that skill set so that it becomes easy for you in a sense. So really what I'm doing with Dual City is already within my skill set. So I'm able to be on a team, play a role that's already within my wheelhouse and add a tremendous amount of value within a very limited amount of time because I already know what I'm doing. I'm able to it's a leverage. So I'm able to say, here's what we need to do here. Boop, 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 boop. And it doesn't take me that long to do because I already know what I'm doing. Whereas if I were to say, go and play a different role within that company, I might have to figure it all out, right? And that would take a lot of my time and energy. So the way I'm able to do both of these things is I'm still very much a passive investor. I'm just taking the skill set that I have and fitting into where it's needed. And because of that, I'm able to drive value where a lot of value relative to the time that I put in.
Sure. Yeah, it makes perfect sense. Any more tax specific questions that you have? I have one that I can think of before we wind down.
No, I think that was a great comprehensive overview.
Yeah.
Specifically for real estate investors. I think we went through some basics. We went through some semi-complex. The only, I guess we'll wrap it with this. It's another very basic one, but can you talk about at the end of the day, people, when they go think about hiring a CPA, they're like, I just want to save as much money as I possibly can with my taxes. What do I do with this? And everyone has a unique situation, right? Can you talk about a few different basic ones and just how to cover these and for business owners? And this is what I mean is writing off meals, travel, car, and I might be missing one. Oh, and home office. I know they're basic, and most people cover them, but for someone that doesn't have a CPA, they have no idea what I'm talking about. Can you just give a brief overview on that and then we can wrap up?
Yeah, absolutely. So as a business owner, if you have a room in your house or part of a room, doesn't even have to be the whole room, that you use exclusively for business purposes and it's your primary place of business, then you're entitled to the home office deduction. Now, the home office deduction, there's two ways to take it. You can either use the simplified method, which is $5 per square foot up to, I believe it's 300 square feet, so up to $1,500, nice and simple. And then the other one is the actual expense method, which is a percentage of your actual home expenses. So if your home office is 10% of your home, you're able to deduct 10% of your home expenses related to your home. Now, the interesting thing about the home office deduction for real estate investors is that the home office deduction is you're only able to take the deduction up to the amount of income that you have. So if you're in rental real estate and you're generating losses, you're not going to be able to take that home office deduction. However, you still may claim the home office because it makes your home a place of business. So now when this actually increases your vehicle deductions, because if you were to drive, say, from your home that had no home office to 123 Main Street, your rental property down the block, that first commute of the day is considered a personal commute, and the miles are not tax deductible. However, if you have a home office, your home is now a place of business, and now you're going from a place of business to another place of business, and you're able to deduct those miles. So the home office actually helps you maximize your vehicle deductions. Now, for vehicle deductions, there's also two ways you could deduct vehicle deductions. There's the standard miles deduction, which is just a simple. I think it's 65.5% this year, if I'm not mistaken, for every mile that you drive. Okay, so that's very simple. You can use an app like Mile IQ or something like that. QBO, there's a bunch of apps out there to track your miles, and I recommend that you track it with that, something like that. And then the other one is the actual expense method, which is similar to the home office. You're able to deduct a portion of your vehicle. Now, something that's really interesting about the actual expense method, if you use your vehicle more than 50% for business purposes and it weighs over 6,000 pounds, so like most SUVs, trucks, some of the Teslas fit into this category, you're able to use bonus depreciation on the vehicle if you use the actual expense method. So, for example, say you were to buy, again, just to keep things simple here, a $100,000 vehicle and used it 80% for business, $80,000 of that is going to be eligible for bonus depreciation. And in this year, 2024, we're at 60%. So you're going to get a $48,000 deduction for buying that vehicle in that first year that you buy the vehicle, if you use it in this example.
Dude, let's pause here. This is great. So we see this all the time on Instagram and social media. And this is the G-Wagon, write-off, right? It's like, I think it costs 150 grand. We can simplify it, call it 100 grand, but it weighs over 6,000 pounds. It's like the sexy vehicle for business owners, right? So can you explain this in, let's just say it's 2024, it's April right now, we're recording this. Say we buy one right now. Is this a benefit specifically to the real estate professional that is going to be able to write this off? Or is it kind of work with the people that have the W-2 job as well and real estate on the side? Like, I'm trying to figure out where that 48 grand, where I'm going to be, am I able to just pay 48 less taxes on that 48 grand? Like, explain it to me. I don't think I'm conceptualizing it the right way.
Yeah, so this would be most powerful for the real estate professional, or say you use the short-term rental loophole, because this $48,000, what this would do if it's non-passive in those circumstances, would that $48,000, so say you had $150,000 from W-2, just to keep things simple here. And if you were able to use this law somehow, because maybe you used the STR loophole, you would pay now only tax. You would not pay taxes on 150 grand. You'd pay taxes on 102 grand. So you're now reducing the amount of money you're paying taxes on, and that could be significant. Say you're at the 35. Let's just 24% tax bracket. Let's just say, I'm just making up a number here. That would be worth $11,520 in tax savings. Now, if you're at the 37% tax bracket, which is the highest one, just to do a draw here, just a comparison, you would be saving $17,760 for that deduction if you're a real estate professional. If not, that loss.
And that's actual dollars. Yeah, that's actual dollars saved into your pocket too, like that you're not paying. So that's where that math comes out.
So I wanted to break it down like that. So thank you. Most people think like, oh, I can write this off, right? So I can write this car off, or like X% of this car off. And they think like from $100,000 car, if you're writing 80% off, they're going to pay 80. They're going to save 80 grand, right? And I just want to like demystify that, where that's not the case. Now, is this only in the first year, right? Let's say we buy the G-Wagon, say it's 100 grand, and we just talked about that 48K we'd save in year one. Does this carry forward, or is that a one-time hookup?
Yeah, so that is that big deduction is thanks to bonus depreciation, which is called first year bonus depreciation. It's like the actual name of it, and that would only be in the first year. The next year you might have a small depreciation deduction, but it's not going to be substantial. In fact, you probably won't even really notice it's there. So this is really a first year deduction.
Okay. I really wanted to break that down because a lot of people think that they can get this flashy, nice car or whatever. Even it doesn't have to be flashy, but like this big, large, expensive car for super cheap if they're a business owner. It's not really the case. You just talked about it. It's a range between 11 and 17 grand. That's a lot to write off, right? Then the vehicle drops to about, if you get the 17,000, right? Then that's like 80, they're paying 84 grand, something like that compared to 100, which is great. But it's not like the whole vehicle, you're going to pay 20 grand on a $100,000 car. So thanks for breaking that down, because I think a lot of people see that and it's clickbait on these reels lately.
Yeah. This this has been really insightful for us. Just having the breakdown of everything here, and I think that people will really resonate with this episode. One of the questions that we've got away from a little bit, but I'd want to ask you is kind of what you do this all for. Like, what is your why behind, being a CPA, investing in real estate? Like, you're sitting on a Friday afternoon, we're recording this podcast, you're putting in a lot of work, you have a podcast. Like, what is the overarching reason or the why behind you and your journey, and what do you do it all for? What gets you out of bed every morning?
Yeah, I mean, at this point, I think it's the momentum that does it. I don't think I could stop if I wanted to, but kind of like what got me in this like path was like, I grew up in like a lower middle class family. I never went wanting for like any, I always had clothes on my back, shoulder, food, but we never really quite thrived as a family. And growing up, I was like, I don't want this to be me. I don't want money to be an issue. I don't want to tell my kids no because of money. I might tell them no for something else, but I don't want to tell my kids no. So this kind of set me on this path, and that's my motivation. So like, I'm a big reader. I read